Well, thank you, Srini, and that was really inspiring. And we also feel inspired. We think we should turn investors into fans. So that's our next mission here, or we're trying. But the other thing that we really like is Vorsprung durch Beschleunigung. Yeah. So I can see I need to make an organization announcement. As you might have noticed, we are running over a little bit, and so we'll skip the break. And subsequent sessions will move backwards a bit by 10-15 minutes. Apologies for this, but I think it's important we also have a space for Q&A now on Germany. I know it's a business dear to your heart, and we start with Simon. I can see you, Simon, from BARCLAYS.
Hi guys, thanks for taking the question. So on wholesale, you've been able to negotiate these new wholesale contracts with your wholesalers that have a very attractive more for more structure on pricing going forwards, and as customers move to faster speeds, and that means we're going to see wholesale revenue growth after a short-term hit. But if we think about what's happened elsewhere in Europe, we've seen challengers actively try and avoid this cost inflation that this brings by maybe moving to alternative network providers. So I'm just wondering, is there something in the contracts that gives you confidence that this won't happen, and how can you get comfortable that, say, if a wholesaler does get reasonable market share, they won't seek to get some help from, say, private money that's very interested in digital infrastructure? Because you yourself said if you get good penetration in a certain area where you don't have infrastructure, then you'll be more than happy to overbuild. So I'm just wondering how you think those moving parts play out and why you have a lot of confidence on wholesale going forwards. Thank you.
Yeah, let me respond with thanks for that question, Simon. So a couple of things. One, there are parts of the contract that we can't really talk about, right? But the overall construct does give us a fair degree of reassurance in terms of utilization of the network, right? And it's hard for me to go into more detail than that, but it does give us a fair degree of reassurance on the utilization of the network. That said, will there be parts and geographies where some people will get some share on the wholesale business? Yes, but equally there are large chunks of areas where we don't have share today. So there will be swap sets that will end up happening as a result of effectively an infrastructure reset, right? But there's enough in those to ensure that that there's a floor to the utilization of our fiber network. And I'm already treading into ground that's beyond which is hard to talk about.
Yeah, thank you, Srini. And it's for sure, we feel very good about these contracts, and we went into a lot of detail as much as we possibly can, right, at the earnings call. But and we are guiding today for flat wholesale access
maybe
revenues.
I should just explain that briefly. Yeah. Simon, the reason we're guiding for flat wholesale revenues, despite the kind of more for more structure, is a well-publicized fact that Vodafone is committed to a certain amount of migration of our network to achieve their cable synergies. So effectively, volume goes down, price goes up. That's what creates stability.
Okay, thanks, Simon. Next question is from Josh at Exane. Josh, good to see you.
Hi, guys. Thanks. I had two questions, please. The first is actually just going back to that very helpful quadrant on slide 12 about the different fiber build areas. I understand the kind of cost of rollout and the potential returns in each of those areas may be different, but it'd be great to get a sense of which of these areas you're going to prioritize most in the near term. I mean, in particular, it sounds like this move to counteract cherry picking could be quite important when we think about the phasing of rollout in 2023 onwards. And then the second question is on this turning customers into fans strategy. So you've highlighted that moving to convergence helps, but are there any particularly strong products in your portfolio, and also particularly challenge products, which you think you need to change the setup on? I think in the past, we've talked about the fact that TV might be a bit lagging a bit behind broadband growth. Are there any actual changes to the product structure you're thinking about as you look to achieve this? Thanks.
Good. So let's start with the prioritization, right? Now, if on that slide, it also had the percentages of Germany in each place, right? So you have 55% in quadrant one. Right? You then have 15, 10, 15, 10, 15, I think, in the rest. Now, broadly speaking, our rollout will follow some of those patterns. Now, what have we announced so far? We've said we will build out 3 million households in rural, right? And that's a public commitment, and that will fit into the right-hand side quadrants. That will be a mixture of subsidies, but also it will be counteracting cherry picking. So that's clearly one place. And then because 55% of the population sits in quadrant 1, you will see us build out there as well, right? So I think there will be slight differences in our percentage of build out versus the percentage of population, but it's not going to be dramatically different because that gives us enough leeway to deal with the cherry picker issue. Because if you take the right-hand side quadrant, yes, there's 15% of the population there, but it's really probably half of it which is attractive to build out without subsidy, which could be cherry picked. So you want to go there first, absolutely. And that we're completely committed to. But that doesn't result in 50% of our money being spent there, just because of the way the math lands up working, if that makes sense. I love your second question on product structures. So firstly, on TV, it's actually a product that we really like, and it's been going very well. As we look forward, one of the numbers I didn't put up there is our plan actually involves an increase in our 3P mix. So from about 25, we're looking to move that to 33%, which is more TV attach rate to our existing products. So it's actually something we see accelerating in terms of where we are right now. Let me come back to your other question of product structures and where that plays out. Look, I think some of the issues with an incumbent tend to be when you have backbook issues, right? And the most significant of those tend to be in B2B. I think what I really like about our portfolio right now is IP migration washed out a lot of those effects, which means we can now start competing in some of those places, SD-WAN migration, for example, without this Damocles sword of the backbook necessarily hanging over us all the time. So my sense of where we are on product structures and what you should be expecting is a lot more focus on convergence and a lot more focus on the Magenta brand in consumer. I think we punch below our weight on the Magenta brand in consumer, and you will see a lot more focus on that. Does that help?
Helpful, thank you.
And that's mainly also relative to, let's say, the Kongstar brand or other. So it's not a very necessarily an imperialist statement. Next, we have Ulrich. I think, Ulrich, we have you on the phone here. Can we?
Yeah, that's right. Thanks very much.
Oh, cool. Okay, go for it.
Appreciate it. Thank you. I have two questions. Second one very short. The first one is the 4% minimum for the broadband revenue growth looks maybe a little bit conservative, considering the MDU opportunity where the changes to the telecoms law means maybe a quarter of households, your competitive situation improves. Is that essentially because you think there's a case for not rocking the boat too much to sort of not disrupt market structure, or what's the background there? My second question is about the 7.5% return hurdle for the project that you mentioned. Is that an all-in number after the loss of the legacy revenues that necessarily comes when you connect the customer to fiber, or how is that calculated? Because it looks fairly high, given that you're essentially replacing infrastructure from one where you have paying customers already. Thank you.
Good. So I enjoy being told that 4% is conservative. Look, we are growing at 6.5 right now. Beyond a point, I am very optimistic about the broadband business. On rocking the boat on market structure, look, I don't like rocking the boat on market structure in general, right? Now, we will gain share where we land up building, but even on the MDUs, in the vast majority of MDUs between wholesale and retail, we have 60% of the customers in an MDU typically are ours. So when I build into an MDU, I'm often building for my own base rather than to necessarily gain share. We will land up gaining share in some places. There are lots of places where there's performance issues with competition, and we will land up gaining share. But the 4% is like I said, given where we are right now, I think we've benefited massively from vectoring. I think there's been some flight to quality as a result of Corona. So we think it's a sensible number to guide for. And from a market share perspective and a net ad share perspective, I think the above 40 still continues to be where we are because we think that's the right thing from a market structure perspective. I think the biggest thing that the MDU access lands up giving us is it frees up consumer choice on TV, but also importantly, prevents people from blocking our entry with fiber, right? So that's the way I think of it. On the fiber IRR, look, we can do a separate, deeper conversation on the specifics of the model. But let me just put some of the questions of fiber economics into context, right? Because I tend to think of fiber economics in the broader context of us running a business, a lot of which is valuation, is based on the terminal value. Now, you think of yourself today in a decision where you don't roll out fiber. 4 years from now, you have largely a copper network, and you have a business where ROCE is greater than WACC. You think of the alternative. We grow ROCE greater than WACC, so we create value at each point, and we have a business with 10 million fiber homes, which clearly has significantly higher exit trajectory as well as terminal value. And happy to kind of walk you through the mechanics of how we calculate the project IRR and what drives the hurdle return, what's included, how much of it is a do versus don't do case, et cetera. And we can take that offline and talk through it in more detail.
Thanks, Srini. So that brings us to the next a question, and that will be from EMMET. EMMET, oh, there he is. Wonderful. Good to see you.
Yeah, good to see you.
Put on a white shirt, really cool. Look very smart.
Well, thank you very much. Thank you. As Srini was trying to speak, or was speaking some German, I'll throw a bit of German in too. So, ich habe 2 Fragen, or 2 questions, please. And the first question is on your broadband market share and the outlook for that. And if I rewind the clock back to, we say, the Capital Markets Day in 2012, I think that's when you announced your initial VDSL investment. And clearly that was let's be honest, it was quite a defensive move because you were losing a lot of broadband market share at the time to cable. Now, if you fast forward to this year, your broadband speeds are now quite high. You've got vectoring available to 80% of the population. It feels like a little bit more of an offensive move. So with that in mind, is it fair to say that you could look at winning market share off cable, off the wholesalers, as I think the motivation for moving to fiber is perhaps a little bit different this time? And then my second question was on the ARPU uplift as you move customers onto fiber as well. Can you say a few words about your experience as you move customers onto VDSL initially and onto vectoring later, and what the read across is for retail ARPUs as we roll out fiber? Thank you.
Very good. Look, let's deal with the first one. I agree with you. Fiber is a more aggressive move in the sense of not purely because of market share, but in the sense of I could sit here and make the argument that we don't need to do it just now. Now, I believe that's a defensive incumbent argument. I fundamentally disagree with that argument because when I think of this differently. I come back from where customers are going to be, right? The upgrade cycle, like I talked about earlier, the 2 principles of the upgrade cycle, everyone tries to stay with their infrastructure until they need to move looking for higher speed. Second, people make one upgrade at a time in terms of speed cycles. Now, you could look here and say, 80% of our customers, right, have at least 1 or 2 upgrade cycles left. Let's milk that and then go on, right? My perspective on that tends to be different, which is let's get the 80% of them done in the next 2 years and get ready then for the next cycle of investment, which will give us another round of ARPU upgrades. And let's fund that by driving our efficiencies really hard. And by the way, that upgrade cycle will help fund itself as well. So I agree with you on it is not the classic incumbent way of thinking about it, which is milk the asset as much as you can for now. But it's the market share gain, it'll happen when it happens. But the bigger prize here is the growth within our own base. And for sure, we will land up gaining share in some areas, right? But we also need to make sure that it's coherent with the right structure. The ARPU uplift, great question. Look, there's a €5 ARPU uplift typically with each speed up that you move from, right? What we have seen in the vectoring cycle is order of magnitude of 5% ARPU growth, annualized about 2.5%. Right? Now, this is where you kind of get into the question of is 4% conservative or not, et cetera, et cetera. I would expect us to see at least the same because what you will land up having is more of a mix of the higher speeds. I mean, here's how the typical pricing works, right? It's €5 an upgrade up to about 250 Mbps. And then it tends to be more like €10 an upgrade because the curve gets sharper. So I'm hopeful of seeing an acceleration in that, but I will plan on seeing the 2.5.
Good. So I think we take two more questions now. And the first one is from George at CITI. George, there he is. Wonderful.
Hi, guys, and thank you for taking my questions. One is a follow-up on some of the comments you've just made around pricing. It's very encouraging to see that your significant fiber investments have been given some returns as part of the wholesale agreements. But I'm guessing some of the other resellers may want to raise prices over time in order to pass through some of this inflation to the customers. So I just want to hear from your side, what do you plan to do in order to maybe give them the room to do that in order to raise ARPUs, not just when migrations happen, but maybe in a bit more active way yourselves? And then the second question is more around capital allocation outside of fiber. So fiber is slow returns, but low depreciation. We can understand the mix when you benchmark with returns on capital employed. But in the previous presentation, Tim also mentioned about cloud native networks, IT. And some of these things are easier to do when you're greenfield than when you have a huge established base and also a legacy of technologies. I'd be interested to hear from your perspective, what are the challenges in your view, and does that mean you depreciate some of your existing assets earlier in order to move into cloud native solutions before competition?
So let me start with the pricing piece. Look, I think two or three separate perspectives or reactions to it. I tend to think of speed upgrade driven ARPU increases as healthy, and there's a real danger in fixed line, right? Where sometimes you are the only supplier in a region, and you view that as permission. Sometimes, like cable in parts of Eastern Europe, to have an annual round of price increases. I think that can get dangerous from a pure customer experience perspective, but also from a regulatory perspective. So I have a bias towards growing ARPUs through as people upgrade, right? The way I think about room, and I think a healthy market structure is always worth keeping an eye on. And one of the things I keep a really close eye on is how is our net add share evolving? Are we making sure that we're at the right mix in terms of net add share? And that's where I think your really good question on how do you make sure you give people room plays in, because they can ultimately their pricing is their own call. I look at titrating my mix in terms of what is my net add share, and I think that's appropriate from a healthy market structure perspective. On capital allocation, and especially on new technologies, Claudia will talk a lot about it. Look, I think firstly on the IT side, I think the view that somehow incumbents have a huge disadvantage is increasingly changing, right? As you get into a world where you're able to introduce, for starters, an intermediate layer which is API-based, you're able to start with overcoming a lot of your disadvantages. And then there's so much cloud-native IT available today that you can piece by piece start taking apart your old BSS and OSS to do a 3-year migration. Now, I think the old world of if you're an incumbent, all you have to do is a big bang IT project that costs 3 times as much as you thought and takes 3 times longer, I think we've proven now in several countries that that's a myth. And in Germany as well, we're making the same journey, right? I think your network question, I think there it is harder to swap it out overnight as an incumbent. But I also think, the components of a network cost structure are more complex, and there are several incumbent advantages in it. The amount of spectrum you have, a huge advantage. The amount of towers you have fiberized. Yes, it's easier as a new player to come in and establish a cloud-native core, but the core is a small proportion of the total cost structure, right? And scaling is really hard. I mean, just to give you an example, let's say you have a player in Germany who is building a cloud-native infrastructure. They can build that, but it'll take them 10, 15 years it'll take them 10 years to get to 50% population coverage. And that scale itself does have limitations purely because of the availability of sites, the antenna available on rooftops, et cetera, et cetera. All of that does impact their ability to really attack. For us, on the other hand, as an incumbent, we are in a place where if we started pushing on O-RAN, which we are doing now, and we're looking at lots of options of really scaling O-RAN, in 4 to 5 years, we could have a significant part of our network disaggregated, and we will always have our 30-odd thousand sites, which gives us a scale advantage. So I think there are puts and takes on it.
Excellent. And of course, more on this from Claudia tomorrow. And last question, please, is from James. James, good to see you. Go for it.
Yeah. Hi, Hannes. Hi, Srini. So 2 questions from me, please, first. The first one would just be interested to hear a bit more about your targets around B2B growth. And I'm thinking about this specifically in the light of what Vodafone said yesterday. They specifically were talking about increasing their investment in B2B and seeing considerably higher growth rates, maybe heading towards mid-single-digit revenue growth. I mean, is this an opportunity you see where you might actually be able to increase investment more in Germany and potentially drive higher growth than you're targeting at the moment? Or do you see something specific about Germany that maybe the B2B growth rates in this market are going to be a little bit lower? And the second question I had, please, was around the network economics you were talking about in some of these joint fiber projects, and just love to hear a little bit more about how that works. So your projects, for example, with Net Cologne or EWE, as you're migrating customers potentially over onto those shared networks, how are you incentivized to do that if you're moving from 100% ownership of a network to a network that is joint owned? We'd just love to hear a bit more about how you see the economic payback from those models. Thank you.
Good. So let's split 3 different types of models. James, sorry, I'll deal with your second question first. 3 different types of network economics models, right? I think the Net Cologne one is a pure whole buy. Right, and so that's why I said this is my last resort. Right, I do lose margin in the process of moving to a whole buy. Right, that's now we have whole buy today in FTTC. We will have some whole buy tomorrow in FTTH, but that's not going to be the center of my economic model. AV-ATEL, very different case. That's one of the bottom left quadrants, right, where we didn't have FTTC, reasonably low shares. There's a lot of upside in creating that model. The third different model is kind of the KPN APG model, right? Which is if we get into a model with an investor. Now there, the way we maintain as close to owner economics as possible is by trying to figure out ways in which we can effectively capture a lot of the value between the passive and the active layer, right? Because when you de-average a network, right? Ideally, when I buy someone else, I want to buy passive. Or if I'm buying active, I want to be the provider of the active services that go with it, because I have scale on active, right? That's how I think about making sure I get close to owner economics and gives me incentive to migrate. Or in the AVA-ATEL case, there's pure upside. And net cologne, whole buy is whole buy. I will do it, but I have to. But it's not my going in. It's not my going in choice. And I would ideally prefer to do it when I do it with community-based players like AVA-ATEL rather than pure overbuilders and cherry pickers. So to your first question, B2B growth. Look, I think there's upside. I think the place. I don't think this is a question of investment in our case because we're making the investment in fiber and networks and infrastructure. I think the real question here is for us, how do we make sure that we develop cutting-edge B2B product, right? And cutting-edge B2B product, both in terms of software-defined networks, but also things. I mean, Tim's point earlier, being able to manage a disparate, diverse network. And being able to control and automate it, right? That plus areas like cloud communication, right? So I don't think this is network investment. I think this is product investment. We do foresee a fair amount of that. Is there upside to the 2%? Yeah, I'd love for there to be. Right? Am I happy to say right now there is? We'll see. I mean, I think you can bet too much on things like the EU Recovery Fund. I saw a lot of press about that yesterday. If those tailwinds blow in Germany as well, then we will benefit from it more than anyone else.
Excellent. Thank you so much, Srini. And that brings us to the end of this Q&A session. And of course, we'll be talking to you a lot more in the next weeks, months, and years on many of these subjects. So apologies again. For taking your time, taking your break away. And we come to the next session straight away. And the next session is on Europe. And our next session will be presented by Dominique Leroy. She doesn't need much intro in this audience here. We are delighted to have her in our management team. At our last CMD, we presented our turnaround plan for the European segment. Now, 3 years on, Europe has become one of our best performing assets, Europe's best performing telcos. And we have the same challenge as in Germany, how to accelerate, how to make something good even better. This is a noble challenge, and who would be better qualified to take this challenge than Dominique? Dominique Leroy.
Thank you, Hannes, and good afternoon, everybody. I'm really happy to be here in my new capacity of board member Europe. And I'm sure you remember, 3 years ago, Srini was standing here and was talking about turning around Europe. I can tell you that today, I'm very proud to say that the turnaround has been done and that we are today a leading large-scale European telco, and on top of it, a very fast